Bismillahirrahmanirrahim. So, I believe in learning by doing. So, I was at the State Bank. Har 2 mahine, every 2 months there is a monetary policy decision, in which what we do is we decide on what is the MMOR going to be. That is the money market overnight repo rate. Now, what is this money market overnight repo rate? First of all, we need to know. So, this depends. How much do you know about the creation of money? That's the basic thing. Does anybody can anybody explain what the money market overnight repo rate is? This is actually you see the State Bank has many instruments which it can use to control the money supply. It can set ceilings. Chal raha hai, I think it should be fine. So it can set ceilings on the interest rate that the banks have to pay. It can make many kinds of regulations. It can the other part which we did not decide in this, and that's decided separately, is called the open market operations. In open market operations, what are open market operations?
Buying and selling of government securities.
Yes, that is correct. Buying and selling. So, why does the government sell securities? To get money to carry out its projects. What is the effect of selling money on the money supply? Selling bonds, selling securities. Yes. So when you sell securities, this is called mopping up, and this means that you are reducing the liquidity that is available in the market. The opposite is to inject money, which happens when what do you do? When you buy back your securities. This is the usual tool of monetary policy to control the amount of liquidity. But actually in the recent days, this has received, for reasons that I will explain, this has come to have secondary importance. And the main tool for monetary policy is the interest rate. So the main tool for monetary policy is the interest rate. Now, there are many interest rates. So the MMOR, the policy rate, is the money market overnight repo rate. Now,
which commercial banks can get from?
Yes, very good. So now, why is there an overnight repo rate? This is important to understand.
Because banks have to balance their balance sheet.
Exactly, very good. The banks have to balance. Now, you see, the mechanism of money creation is not what is usually taught in the textbooks. Do you have a textbook? By the way, not sure. Say you have interference with that. Try to understand what I'm trying to say. तुम्हारी बुक्स में कोई बुक है जो तुम इस्तेमाल कर रहे हो? No book. Have you had a course in monetary before?
No.
So how can you study without textbook?
Give us articles.
Achha. So how is money created? Currently, if you look at the State Bank Bulletin, it will say that the central bank reserves amount to about 3.5 billion rupees, and the total amount of money in the economy, is around 7.5 billion rupees. So, what is this money? How is it created? एक तो वो है जो नोट्स छापते हैं, there is some additional money which is not those bonds. Where does it come from?
Some credit.
Credit. Yes, but so how is it? How does this system work? How is credit? How is money created?
So when mutual funds demand for money, so State Bank give them make their accounts and issue their money in accounts, not in paper form.
Yeah.
So that's
Okay, but if the bank borrows money from the central bank, that doesn't really create money.
Sir, for example, if I have 1,000 rupees and I want to deposit it in the bank, then I will be the depositors and bank will keep some portion of that money and then it will further
Oh, achha. This is the usual mechanism which is taught in the books, but it is completely wrong. This is not how money creation works. That's what I wanted to say, that because the textbook normally will tell you that this is what Uzma has just said, but it is not how it works. So according to the textbooks, the banks are intermediaries. They gather the money from lots of people and then they take that money and give it to investors. This is not true. What happens is that actually banks are creators of money. When we go in and we all deposit our money in the bank, so the bank has deposits. Now somebody comes in and he says that I want to borrow ₹1 billion. So the bank says, fine. He doesn't look to see, do I have ₹1 billion? No. It just creates an account and says, okay, you have ₹1 billion. From nowhere, zero. This is how money is created. When the bank goes, they say, okay, we have opened an account in your name and you have ₹1 billion in this account. There is no money. But money has now been created. This is the additional 4 billion. All of it comes in this way. So now, what happens? Well, normally people don't borrow this money and put it in their pockets, although that's also possible. Normally what the man will do, he has borrowed money and he will say, okay, I will write a check to so and so. I borrowed money from the bank, I want to buy machines, I want to buy industries, I want to pay my employees and so on. So after borrowing the money, he will write, he has now an account on the bank, he will write checks on it and checks will go flying in different banks. Similarly, other people have been borrowing from all other banks and they will be writing checks which will be coming into this bank. So at the end of the day, there is a massive clearing which is done. The banks close down and then they start clearing. कि इतने हमारे चेक्स उधर गए, इतने आए, सब सारे बैंक का मिल मिला के एक नेट होता है. तो in the net, if nobody has taken cash out from the banks, then some banks will be plus, some banks will be minus. Overall, it will be zero. So now, but some banks will be minus. This bank, suppose the man he asked for 5 billion rupees and the bank didn't have 5 billion. They made an account and the man writes a check and nobody deposits in this bank. So now you are at negative 5 million. What do? Well, you have given that loan at 10%. So now you borrow money. You can borrow money from interbank borrowing. You can borrow because somebody else has plus. So normally banks borrow this money from other banks. Somebody is plus, somebody is minus, it will always balance. So in fact the clearing system is set up to say, okay, this bank is deficit, this bank is surplus. So they tell you, okay, they have the surplus, so you can say, okay, can you lend it to me? This is almost automatic, it's done mechanically. And that's what the LIBOR is, the London Interbank. We don't have LIBOR, we have KIBOR, Karachi Interbank Borrowing Rate. So if you have somebody bank has surplus and somebody has deficit, then automatically you borrow. And so at the end of the day, everybody is at zero. There is no loss, no However, sometimes it can happen that people took the money out and put it in their bag, and now they have the money sitting in cash in their home. So overall, now there is a deficit. The bank, instead of writing checks on he borrowed 5 billion, he said, okay, give me the cash. Now what happens? Well, this is where the bank is required to maintain some amount of reserves in the Federal Reserve, in the state bank. So the bank says, okay, now it's an emergency. Suppose it has no deposits, so it says, okay, I will borrow money from the state bank. Normally it has to have, in fact every bank has an account at the state bank which is in some proportion to the amount. So they have some money, but they can also borrow money from the state bank. The state bank is orders to freely lend. There are some rules which govern this, but anyway, so to make sure that there is not so much risk. So anyway, the bank, he can borrow the money. Okay, I will borrow the money and I will lend it. So it borrows the money from the bank and it calls the state bank that, okay, I need cash. So the bank then prints up the cash and then they send it. The cash is printed on demand. There is no, and it's not, if it's needed then you print it, otherwise you don't. So the bank says, okay, give me the cash, give me this money in cash, then they will send it the cash. And if the bank doesn't have the money in its reserve, it can borrow. Now normally, because of this is daily clearing, so at the end of the day and random balance, so it's overnight borrowing. In the morning you start at zero again, and then at the end of the day you have to cover it at zero. This is why there is this MMOR. In principle, you can do it every day, so there is no harm that you can. So the MMOR then controls basically if you want to make loans, somebody comes in and he asks for 5 billion. If you are asking 12% interest and the MMR is 10%, then you are safe. You are going to get 12% and you are borrowing at 10%, you are going to make a 2% profit. So you can do it as long as the loan will come back to you. Now if the loan is defaulted, then you may be in trouble. Now there are various things you can do to avoid this trouble. There is insurance for loans. One of the most common forms is mortgage insurance, where if people buy loans to buy houses, then actually mortgage means that you have a claim on the house. If the man fails to pay the loan, you can just possess the house and sell it. So very often the loans are guaranteed by collateral. But if the loans are not guaranteed by collateral, then you can also buy insurance on those loans, that if the man does not pay, then the insurance company will pay. In fact, often you can force the person who is borrowing to take the insurance. There are also derivatives which do the same thing as insurance policies. So they are basically these ways. Those complications we won't go into, but the main point is that if MMR is low, then more people will then you can offer loans at a lower interest rate. If you offer loans at a lower interest rate, you will get more people to borrow, money supply will increase. Right? Understood? So that's what the MMOR is. Now I am going to tell you that, okay, what they did was, they reviewed at the meeting, they reviewed the fundamental of the economic situation in Pakistan. This is in January 2015, not too long ago. It was in middle of January. So we are going to just go over. This is the presentation that was given to us, and then after this information, we have to make a decision on what to do to the MMR. Should we raise it higher? Should we lower it? How much should we lower it? So you are now going to be trying to make this decision. So just follow carefully.
Commercial banks are so independent, then what is the role of central bank, like reserve requirement by the central bank and statutory liquidity requirement? These are the rule of monetary policy to control
Yes. Well, you see, suppose that the bank has basically the reserve account makes sure that you can't lend too much. I mean, you have a certain amount of money. Let's say that the depositors have deposited 1 billion rupees in my bank. Now I can lend up to 5 billion, 20% requirement. If I put 1 billion in the reserve bank, in the state bank, I deposit all of my money in the state bank. Actually, you see what will actually happen, realistically, practically. If I have 1 billion, I need to keep about 20% of that for myself, because that's about the amount that day-to-day transactions maximum for liquidity. Exactly. Every day people are coming in, cashing checks, and I have to have the money to pay them. So if I have 1 billion, I will keep 20% of that as cash. 80% I will deposit in the state bank. Now, when I have 80% of this money in the state bank, then the bank will loan me up to 5 times that amount, and not more than that. So if I make a loan for trillion rupees and I say, okay, give me trillion, bank will say, no, you don't have the reserves with us. So I have an upper limit to how much I can lend, but it's pretty high. I mean, it doesn't have a direct, and basically the idea that banks are financial intermediaries, that I take the money from the people and I lend that's not true. I create money, but the money creation is bounded above by the amount of reserves that I have in the state bank. Okay. Oh, अच्छा इसको start करना है. All right, so this is the presentation that was made to us before we make the decisions. So here is the inflation. This is the actual outlook. You can see that inflation was in August 2012. Where was it? It was around 11%. Well, actually, you see there are two lines. There's the red line is the actual inflation, and this is YOY, year on year, which means that you look at the price in August 12th, the CPI, and you compare it to what it was in August 11, and that is the inflation. This is year on year, as opposed to month inflation, which is you take August 12th and you take the previous month and you ask what is the inflation. So this inflation was around 9%, and you can see that it has been varying, but since about May 14th, it has been coming down. The green line is a 12-month moving average, which is sort of, and the average is out random fluctuation, so it's sort of what you call the long run trend. So basically the CPI inflation and its expectations. One thing which matters is how much people think the inflation is going to be. So they are going down. Headline CPI inflation, this is the inflation that is reported in the newspapers, came down to 4.3% in December 2014. Average CPI inflation has come down to 6.1%. This average is not reported. It is just the State Bank calculation. So, you see, if we take, you can see that the red line is erratic, jagged. So, we don't want to make a decision on the basis of what happened last month. That's not a stable number. We want to look at the average for the past 6 months or so. And that average is around 6.1%, it says. And the Consumer Confidence Survey reports subdued expectations, that is, low expectations of inflation. So, people are thinking that inflation will not. This is very important, as we will see. So, this is the report on inflation. Again, inflation is the low in prices, the fall in prices is broad-based. Food inflation and non-food inflation have been declining, following similar trends, although different numbers. You can see that it declined up to about August 13th, and then there was a slight rise up to August 14th, and then since August 14th, they have been declining. So inflation is going down. So just on this basis, what should we do to the MMR is around, I think it is 9.5% or so. So what should we do? Should we increase the interest rate or should we decrease the interest rate? Huh? Decrease. Why?
Now that we get the money, the prices may go up, so production may increase.
So the cost of production can be reduced, which will reduce the prices, and overall general public will be benefited.
Okay, but suppose the inflation was rising, then what? What would we do? Yeah, then we would like to increase to reduce the money supply which is created so that we can control the inflation. That's the general theory, yes. Underlying inflationary pressures also show downward trend. This is again month. The blue lines are the month-to-month changes. Red line is year-to-year. And I don't know what this NFNE is. I don't remember what it is. And trimmed inflation. Okay. Now, when we increase or decrease the interest rate, this also has an effect on the exchange rate and also on the balances, balance of payments. So that is called the external sector. So when we make those changes, we have to think about what is going to happen in the external sector. So this is the picture of the external sector. The current account balance is negative $3.1 billion. What does this mean? In July to December, there was minus 2.0 billion dollars deficit. What does this mean? We imported. This current account means that cash transactions. So we paid $2 billion of money went out, and the export earnings, basically our dollars that we have to buy comes from exports that we earn dollars, and also from what other source? How does Pakistan get dollars to buy imports? Yes?
So
Remittances is a very big source in Pakistan, exactly. See, you can see the remittances are $15.8 billion, 7.8 billion in July to December. So the remittances are keeping us afloat. Services balance is minus 1.5. Trade balance is minus 8.7. These are merchandise. So our exports earn very little, and our imports cost a lot, so basically minus 8.7 billion is the deficit, but the remittances and other things make up for this.
But suddenly you decrease by imports from minus 16.7 to minus 8.
No, that's not a sudden decrease. This is FY14 whole year minus 16.7 and July to December 6 months. So that's about half. It's the same figure, but what's happening in the last 6 months is indicated here. FY15 is just the projection for the first 6 months, what they expect it to be. So, overall budget position. Well, a large part of our deficit comes from imports of oil, and international oil price has decreased, so the projections are good. We don't expect to face much problems. Sustained decline in international commodity prices, which means that, what does it mean? Import bill will decrease, exactly. Successful completion of 4th and 5th review. What does this mean? This is the IMF tranche that we are getting as when a country, just like the bank, if it has deficit and it cannot pay, it borrows from the state bank. So if we have a deficit in foreign exchange, we borrow from the IMF. Although this is a very bad policy because IMF imposes very stringent conditions and then they check, are you meeting these conditions? That's the review. So what does successful completion of 4th and 5th review mean? Means that you see the IMF gives the loan in tranches, in different in installments, as they say, and they keep reviewing that, are you meeting the targets that we have set. So since we have successfully completed, so we expect that IMF will be giving us more loans. And what about this issuance of international sukuk? Yeah, Islamic bonds which are sold in Europe to raise foreign exchange. So what does all of these factors are saying? Yes, all of these factors are pointed in the same way. It means that our foreign exchange situation, the BOP, balance of payments, will not be a problem. What happens, how does the interest rate affect the balance of payments? If we increase the interest rate, will that help us in balance of payments, or will decrease help us? Which one is going to have positive impact, which one will have negative impact?
Sir, if it promotes consumption.
How is that?
If it interest rate, lowering interest rate promotes consumption, then it will.
Well, you see, how will interest rate promote consumption? The interest rate, what it will do is people will borrow, they will money. Their money is more freely available. If we decrease the interest, then money is more freely available. What will happen to the demand for Pakistani rupees by foreigners who are investing in Pakistan? If we decrease the interest rate, demand for our currency will decrease. Exactly. Yes. So some people in Pakistan might say that, okay, we are getting less return on our rupee here, so what we will do is we will convert this to dollars and send it to Dubai for investment. So if they start doing that, and if foreign investors buy less rupees because the interest is lower, then what will happen to the exchange rate? Yes, there will be more demand for foreign, so there will be. So this will be sort of a bad thing, but given a good budget, given all of these offsetting factors, we don't need to worry about that, right? So cutting interest rate would not. This also suggests that we should cut the interest rate, right? All right, so these are the inflows. of foreign money. If you see that the FDI, it is not hardly worth mentioning. It was high, and you see the highest peak is around April 08, where it reached 1200 billion, and then it has been, there must have been some major privatization वगैरह हुआ होगा शायद. I don't remember. I don't know what that peak is, but that was a long time ago. In the recent past, the FDI has not been very high. There is one spike in somewhere, possibly some particular, maybe it's the IMF tranche, I don't know. So, in the middle of somewhere, something like June 14th, there is a big jump, and then it's also quite trivial. Foreign portfolio investment is also not very, monthly flow is not very good. And
France should not be included in the foreign direct investment.
it won't come in here. Exactly, you are right. It won't come in here. These are FDIs and these are privatization proceeds. Yes, that's right. This is privatization. So now the briefing team tells you, okay, there are some risks that we face, and one of these is that we are calculating our budget on the basis that privatization will be going strong, but actually that might not happen, non-realization. And of course, the private remittance inflow, we don't know very much about. It can be unstable. It has not been very strong recently. Okay, so the broad money increase has not been going very fast because the government has not borrowed. You see, when the government borrows, that also creates money. So just like when private people come and borrow, so when the government borrows from the state bank prints money to lend, and that's actually creation of high-powered money, which will then lead by the multiplier effect to bigger base for the money and therefore bigger broad money. So the government has not been borrowing a lot. External inflows helped in boosting net foreign assets, but net domestic assets decelerated. So external inflows have been good. I think it's probably IMF and remittances, basically. Those are the major factors. The export performance has not been very good, so that's not going to be a big factor. Why did net domestic assets become smaller? Because lower private sector credit and lending to public sector enterprises. The credit to private sector uptake is lower than the same period last year. ये क्या लिखा है? July, December FY15 कैसे हो सकता है ये? I think this is a mistake. FY14 होगा. FY15 तो गलत है. So the government and the private sector has not been borrowing too much from the banks, and what that means is that the money supply is lower because the money creation has not been done. M2 is broadly compatible with inflation and economic growth. If you remember it from the money demand and in the quantity theory equation, that the percentage increase in money is equal to the percentage increase price plus the growth rate. So basically, if you have a certain amount of inflation, and if your money growth is less than that inflation, this will cause a dampening effect on the economy. Standard Keynesian theory. If your money is not sufficient to meet the transactions, then those transactions will not get done. You will have unemployment, you will have excess capacity, and so on. If your money is sufficiently above, money growth rate should be sufficiently higher than inflation rate so as to give the margin for the for the growth in the real sector. You understand? This is a very crucial, important point. This is one of the key issues of monetary policy. Basically, the Keynesian theory is very simple. There is an optimal amount of money in the economy. If you have less money than that, then the economy won't function. Some of the things will not get done. You will have unemployment. If the money is more, then all of the at the right level you are having all of the jobs are being done, and now the excess will go into creating inflation. So trying to keep the money at the right number is important according to the Keynesian theory. But this is a broad picture. There is many details and complexities which means that it doesn't work exactly like this. But this is the big idea. So what they are saying is that, okay, things are roughly on target. There is no serious problem. The money is neither going to, the amount of growth rate that we are having is not excessive and not excessive, so it won't cause inflation, and not too little, so it won't cause unemployment. This is the major issue. Monetary policy is done to make sure that, according to Keynesian theory, that you don't have unemployment and you don't have inflation. It has to be balanced. Okay, so now why did the private sector not borrow very much? One is falling commodity prices. Why would falling commodity prices lead to less borrowing? क्या हुआ?
From profit.
Hmm?
From profit.
Profit expectation.
No, this is not. This does. Well, that won't reduce the borrowing. Profit expectations. हाँ, ये बात सही है आपकी. That might be one factor, but the more direct factor in business is that normally what businesses do, and this is where the Islamic banking comes in, Mudarba financing is exactly this, that normally businesses purchase goods and then they resell them at a profit. But normally they don't buy the goods from their own money, from pocket, they borrow money to purchase and then they repay when the sale is made. So, and this is exactly what the Islamic financing is, Mudarba is exactly, you borrow money to buy commodities and then you sell. But, you know, the difference between Islamic contract and the Western contract is that in the Western contract, you borrow money from the bank at some interest rate and then you buy the goods with your money and then you sell the goods and then you repay the bank. In the Islamic contract, this is not permitted because you are taking an interest-based loan. So what is done technically is that the bank buys the goods for you and then it gives you the goods on loan. Yani, it gives you the goods. Now you have the goods and it asks for, and suppose there is 100 rupees of goods and it's going to be sold for 200 rupees. So the bank buys the goods and it sells to you for 200 rupees but on a delayed payment basis. So then when you sell, then 6 months later when you have sold them, you pay the bank 200 rupees. So now there is no interest because the bank sold you the good at more point. This is how it's supposed to happen, but it doesn't actually happen like this. This is the problem with the Islamic banking, that they don't actually follow the Islamic. This transaction looks like it, but there are many complications. Anyway, that's not the issue here, just to tell you for your general information. So anyway, if the commodity prices are less, then the banks need to borrow, the business needs to borrow less to buy, and so they will borrow less, so the money creation will be less. So, government borrowing from commercial banks amid slower deposit growth. So what is this? Why does this reduce the private sector credit and therefore the amount of money?
Because banks have lesser money. Because government has borrowed money.
Yes. This is called the crowding out effect. When the government borrows from the commercial banks, then the private investors don't. Actually, what is happening in Pakistan, a serious problem for our economy, is massive amount of crowding out. Now, basically, the government, the banks currently, about 60% of their loans are to the government in the form of, they are buying the treasury holdings. So, money that should have been going to the private sector to make investments is not there. The money is being placed in the government because the government is offering good rates. So now, why does the government borrow from commercial banks? Why doesn't it borrow from State Bank? If it borrowed from State Bank, then the crowding out will not occur.
There is a fiscal responsibility.
Mm-hmm.
There is constraint by central bank.
Yes,
Should borrow.
that is correct. But why? What is fiscal responsibility and why is there fiscal responsibility?
Because central bank have to print the note and it will increase the inflation.
This is the standard story that if the government borrows from State Bank and it has basically a free source to print money, then the government can print lots of money and then basically that will cause inflation. And certainly it is true that, and this is what's happening in Greece these days, that the government doesn't have enough money to finance the economy and they are preventing it. The European Fund, European Union, is preventing Greece because actually you see they have only one money, the euro. Everybody surrendered. And this is why the gold standard collapsed. And this is why the euro is in big trouble because basically if you have the gold standard, then you have no monetary policy. The amount of money in the economy is fixed according to the amount of gold. And if it is too little, there's nothing you can do. You can't expand the money supply. So this is what the problem that Greece is facing. They need to expand the money supply. They have massive unemployment, but they can't because of the euro. And so they are trying to negotiate freedom from the Germany. Basically they're saying, okay, you give us high loans. Basically just like the central bank. You see, if the central bank, the Euro bank, they are asking Germany that give us the loans so that we can have more money in the economy. And the German bank, just like IMF, saying, okay, I'll give you money, but you have to do this, that, and that. You have to raise taxes, you have to cut social services, and this and that. And they don't want to do that. Basically, the same thing happens here in Pakistan. That in fact, the government wanted to borrow, in this particular case, from the State Bank. The IMF prevented it. Said, no, you can't. Now, the question is, $1 million question. Is it true that if the government borrowed from the State Bank, would it cause inflation? Currently, we have very low inflation. So, even if it caused a little bit of inflation, so should we actually borrow from the private sector in order to finance government expenditure? And with this fiscal constraint, it means that the government cannot build schools, cannot build roads, cannot do a lot of social services. Basically, that's the big problem. Same thing is happening in Greece. The government cannot provide health service to the people and so on because they don't have the money. They could have the money if they borrowed from the State Bank, but according to the IMF, it will cause inflation.
But sir, it depends upon the credibility of government. If government is efficient and allocate the resources productively, then it will.
Yes, that is good.
But if it spend on non-productive and.
Exactly. This is exactly correct. This is the issue. Basically, you can think that there are two views. There is the Keynesian view and there is the IMF view. If the government borrows, now in Pakistan, do we have unemployment or do we have, is the economy working at full capacity? Massive unemployment. So according to Keynesian theory, if let the government borrow freely, in fact, that's what Keynes said, that you can helicopter drop money over the man and that will augment. So he wants to print money. And he said that, okay, if you can't do monetary policy, do fiscal policy. Have one team of people come in, they have them dig ditches and then give them money to pay, and then have the next team come in and have them fill up the ditches and pay them money. That will also put money into the economy and that will get rid of your unemployment. So, according to Keynes, there is no harm in printing money. But IMF says, no, don't print money. So, Yes.
So yeah, sir, government की productivity भी तो नहीं है, because what you're showing is they're falling with the commodity prices, and private business, they are not basically उनका जो basically investment into their business is also decreasing, that means, right? Because they're not borrowing from the
I'm looking at this item here. The government borrowing
has slowed down.
as from commercial bank, the government is borrowing, and there is slower deposit growth. यानी there is multiplier effect की बात है कि the bank have less money to lend because of slower deposit growth, and all of it is going to the government. So there is the private sector has very little amount.
Basically, जो पैसे हैं वो गवर्नमेंट के पास आ रहे हैं, so investment into the private sector that basically uses that cash for the private investment, that is going down.
Exactly. The government sector borrowing is crowding out, and this need not be the case if the government borrowed from the state bank. But the government has been prevented from borrowing from the state bank by the IMF. And the key question here is whether the Keynesian view is correct and whether the IMF view is correct. What is your name? Mohammed Luqman. Brilliant. Mohammed Luqman got the answer. I have a chocolate for you. Not in my pocket. So, basically it depends on the government's responsible behavior. If the government borrows the money from state bank and uses it correctly to do projects to increase employment, then there will be no inflation. If the government uses it and it goes into the pockets of the senators and they buy foreign luxury goods, it will cause massive problems for the economy. In the past, this has happened. The government has looted the treasury when the state banks were all nationalized, and the government had access to infinite amounts of credit, and they caused massive amount of damage. So that's what fiscal. But this doesn't mean. So now the problem is that this is something. That's one risk. But the other problem when the government borrows from the private sector is that this crowding out occurs. And one more thing that happens is that when the state bank creates money, the government doesn't have any repayment liability. When it borrows from the credit sector, it has to repay that money. How does it repay? Well, first of all, the crowding out occurs, that's one harm effect. How does it repay? Well, it has to collect taxes. Now, the taxes are very high, and all the time you hear the planning commission as saying, okay, we have tax GDP ratio 9%, it should be raised to 18%, so that the government has fiscal space, so that we have the money to invest in good projects. So now, if the government raises taxes, this has a very harmful distortionary effect on the economy. The businesses cannot run. If you reduce the taxes, then the business would be able to run, but now with the taxes it's not profitable anymore. The government doesn't have money to finance social services. The fiscal burden, there are three harmful effects when the government borrows from the private sector. One is that there is no fiscal space to provide social services. Two is that there is crowding out. And three is that taxes. Exactly. Taxes are to be increased to finance. If the government borrowed from state bank, none of this would happen. But there is the danger of inflation. Yes.
If we know what is better for our economy, as you mentioned, then why we following IMF conditions?
Because
we have borrowed money from them. So if we don't have, so in order to get out of the IMF, Brazil में 1999 में it was the most indebted country in the world. 2003, Lulu came to power, and he turned the country around. He created a public bank, borrowed a huge amount of money from his own bank, which is basically zero. You see, the point is not borrowing money. The government has the authority to print money. If there is not enough money in the economy, print it. And you see, this is the problem that people don't understand, because people are confused about nature of money. They think that money has to be backed by something. Actually, it's not. Doesn't have to be. Currently, all of the money is unbacked. There is no backing for any money. No, dollar doesn't have any backing, and rupee doesn't have, nothing has backing. But it's still working. But how it works, it's a mystery to most people. So anyway, the point is that the Brazilian president, he turned the country around when he printed money, and used it responsibly. This is the key, which you have pointed out. If you use that money to create productive capacity, then you can pay it back. And then what he did was he paid back all of the loans to the IMF. And then now Brazil is having a tremendously, this is the BRICS, Brazil, Russia, India, China, they are all having great performances in economics because they have taken control of the money supply. China also, India also, Russia also. They all have. The government has control, but we don't have control of our money supply. Challenging security of mind. Why does that make any difference? You see, I'm looking at this.
We have to spend a lot of money on security, and secondly, there is fraud and foreign direct investment.
Yes, that's right. The credit to private sector. This is the title of the slide. Why is the private sector not borrowing? Because you want to set up a project and your security is low, then there are risks which you cannot. So, fiscal deficit. Now, how does that matter for monetary policy? Well, we've just discussed that. If the government borrows from the private sector, then it causes problems of one kind, crowding out type. If it borrows from the state bank, it can cause problems of the second kind. This is inflation. So, fiscal deficit is doing all right, even though interest payments have increased. That's because of commercial borrowing and because of international sukuk. These are both heavy, and this is going to cause us big damage later on, because if the commodity prices are decreasing and the well, basically our payments will be high. We have promised interest rates are falling, inflation is declining. Now we have given fairly high interest rates on these sukuk, and so we are going to be stuck with a very high burden of payments. But the government is doing well because they are not spending too much. Contained expenditure related to public sector enterprises, budgetary borrowing from SBP remained below target. Pace in development expenditure still remained high. FBR collection was not good because of downward adjustment in petroleum prices and lackluster performance of the large-scale manufacturing sector, which pays a large proportion of the taxes. So, liquidity. You see, now this is saying that the liquidity remained tight, that is, not much money is available for the private sector. If you look at the orange line, that is the policy rate. This is the MMR rate. Which is what is being set. it is at 10% up until here and 9.5% until the 15th of January, at which point we made a decision on what to do. In fact, I was there and yes, in November 14th, I was also part of the monthly, and we had the same type of presentation. I was there at the monetary policy, and we decided to cut the rate from 10 to 9.5 at that point. So you see this decision over here. This green rate is what is the actual free overnight repo rate, which is in the interbank rate. So interbank rate is always below the policy rate, because if it goes above, then banks will borrow from state bank instead of from other banks. So this is the maximum. If the rate is below, it means that the liquidity is not tight. If the liquidity is over here, this means that the position is tight. Banks don't have much money to lend to each other, so people are borrowing from the bank. This means that there is excess liquidity around because banks have enough money, so they can lend money to each other at lower rate than the bank is offering. So the fact that the green line is touching the top, this is what means to say that the liquidity is tight. Now these are the open market operations. On the whole, we are having injections into the money market, which means that these are the decisions which are made by some separate committee on monetary policy, and they are selling, they are buying back their treasury bonds, and they are reducing the liquidity, and increasing the liquidity, by putting money back into the. So here in the quarter of foreign markets eased substantially, government shifted borrowing from SBP to commercial banks. Okay. Macroeconomic conditions. Okay, consumer confidence is high. Lower expected inflation for next 6 months. Business sentiments are likely to improve further. What difference does this make? What business sentiment is and consumer confidence is? What is the impact of these things on monetary policy? Yeah, what?
Businesses will increase their investment.
Yes, exactly. They will borrow more. Private sector credit uptake will be more. Money supply will go up. Similarly, consumer confidence is also good because inflation depends on inflationary expectations. This is very important, not very well understood. If everybody thinks that the prices will increase, then you see when they plan for this, it's a self-reinforcing effect. It creates this. So the prices increase because everybody expects it. So the banks, all of the actions are taken in the anticipation, and they create the price increase automatically. It's a complicated mechanism. I might discuss it later. So both of these things are good in the sense that, well, the consumer confidence index shows that, okay, we can, if we cut, basically we are thinking about cuts now because of all of this. Now if we cut the interest rate, the consumer confidence, what will the effect of that be? How does it support our decision or does it go against our decision? It supports in the sense that if I plan to cut and then the consumer confidence is, this will have an inflationary impact. But if the consumers believe that the inflation is coming down, this will help to counteract this inflationary impact. So this supports our decision to cut. Business sentiments are likely to improve. it means that the private sector, the monetary money supply will increase. This has a dual effect. On the one hand, it means that the money supply will increase, which is inflationary. But if the businesses invest in the economy productively, this will also generate real growth, which is the Q part in the MV equals PQ. So, if the more money is needed for productive activity, then it is not inflationary. So, this is good. This is also good for us, in terms of the decision. Okay, prospects for better agriculture is good, and activity in certain types of services is good. So all of this means that we need more money in the economy. So again, this supports cutting. Real GDP is expected to maintain. So again, when we look at MV equals PQ, so the inflation has to, the money supply has to make sure that it can support the economic activities. So we have some. Okay, so that's it. So now the decision is how much to cut the interest rate. And so there's voting, there's lots of people there, and everybody says, what should you do? So what do you think the decision was? So how much do you cut the interest rate? 9.5. Last 2 months ago we cut it from 10 to 9.5. Now, how much do you think you should cut? Your vote.
9.5 to 9.
Basically, the way they say is that it's 50-point cut. This is what she is saying. She wants to cut the interest rate by 50 points. What about you?
It's 100 basis points.
100 points?
At 1.5.
You will follow the monetary policy? I don't understand what you mean.
Because they have decided to cut by 100 basis points.
Oh, you know already?
And right now it is at 1.5.
He knows the decision, yes. Okay, so I thought that you wouldn't know. Okay, so that spoils it. So that is actually the first vote was 0, no cut. He said that all of this is speculation, we don't know what's happening, let's just sit tight. So let's keep it. The second vote was 50-point cut. Third vote was mine, I said 100 points. And then about 5 people said 100 and one of them said 50. So there was 1 vote for 0, 2 votes for 50 and 5 votes for 100 points. And so the governor said, okay, 100 points. Okay. Then I wrote a little note saying that, look, we are making these decisions, but we don't have any model. And what will happen? And we were saying, okay, this is all hand-waving, qualitative. You should have a model which says, okay, when we cut the interest rate by 50 points, then what will happen to the inflation? What will happen to the money supply? So we should have some equations. Now, actually, I have estimated some equations because they didn't have them. And so next decision I will be able to take the... So how did you know about the monetary policy decision?
Sir, it's already.
Oh, yes, but you're following this stuff. Achha. Very good.
We had an assignment on this.
You had an assignment on this, I see. Very good. All right. Now, okay, I think I'll stop here. I could present the monetary equations and explain some of those issues, but that will be next lecture.